Good afternoon, and welcome to today's CFA Boston webinar on integrating system-level investing into practice management. My name is Michael Grice, and I'm the chair of the CFA Boston Sustainable Investing Committee. We've been in place since 2013 when we ran our first full-day Sustainable Investing Conference. We've run 7 such conferences and are looking forward to resuming our full-day events in person in the fall of 2022. We also develop shorter events in series in between the yearly conferences. And since last spring, of course, these events have been virtual. I will include into the chat a link to the Sustainable Investing Initiative page on the CFA Boston website so that you can check that out and reach out to us if you have interest and suggestions and ideas for what we do. There's also a Sustainable Investing community on the CFA Boston Connect community site, and I'm going to ask Caitlin to put a link to that in the chat. So today's event is the second in a series on systems level investing. The series is a collaboration that we've assembled of several Northeast area CFA societies and the Investment Integration Project, the folks behind the ideas of system level investing. And those ideas were originally developed by Steve Lydenberg. Steve has been a pioneer in this field for 40 years. He has always been thinking about what's next. I've had the pleasure and the privilege of knowing him and working with him for over 15 years. And his ideas were the foundation for the Investment Integration Project and the book, 20th Century Investing, co-authored by Steve and our opening discussant, Bill Burckart. Bill is the president of the Investment Integration Project, as well as the co-author of the book, and he has been leading the work to move the ideas of system-level investing into practice. And our thought and our ideas behind this session today is that we believe that there's a lot of opportunity as we think about how we approach large problems and how clients are coming to advisors and others and asking how their investments make a difference. There is room and there is an opportunity to move beyond where we have been and bring these ideas into how we serve clients, and we actually use investing to really address huge system-wide, society-wide issues and challenges. So Bill is going to open with a conversation and an introduction to that. And then our 4 panelists, we have assembled 4 of your peers who really represent a wide range of clients and firms. And that's Kim Gluck, CFA. Kim is with Boston Trust Walden, Dune Thorne, Rick Smyers, and Nakia Maddox-Eubanks. And each of them will introduce themselves as they begin and get involved in the conversation, talk about their clients and how they are thinking about these issues. Encourage you to please put questions into the Q&A, and at about 1 or a little after, we will move into questions. And if we have the opportunity to address any questions as they come up, we'll certainly do that. So with that, I'd like to turn it over to Bill to kick us off.
Thanks, Michael. And thanks to everyone for joining us for the second session in this event series. So I'll start with the most obvious of obvious observations. The world has always been a risky place. But as I discussed in my new book with Steve Lydenberg on 21st century investing, the context, the scope, the scale of today's risks have changed. They are less local, they're more global. Melting polar ice caps, species driven to extinction, embedded social inequities, and destabilized democracies. These are really harder to undo. And challenges like income inequality and climate change threaten to destabilize the very fundamentals of social and environmental systems. The world was woefully unprepared for the COVID-19 pandemic and continues to be unprepared for its unpredictable long-term social and economic impacts. For example, a study by the Cambridge Center for Risk Studies suggests that social unrest from things like chronic youth unemployment, a systemic risk of increasing likelihood, threatens investments across all asset classes. The Sustainable Accounting Standards Board has identified climate change as a material systemic risk to the majority of industries that compose the US economy. And as we cover in the book, conventional investors continue to invest as usual, ignoring massively destabilizing challenges and giving little thought to the contributions they make to them. Instead, situations get worse as they rack up short-term profits. They view sustainability and environmental, social, and governance, or ESG factors, with suspicion. They believe that they will lose money if they go down that road, and that this way of investing is no more than a passing fad. When it comes to all things social and environmental, if government hasn't told them to do it, they can do whatever they please. And anyhow, whatever they do doesn't really change anything. When asked why they don't do anything about systemic crises, they say, my job is to make money. Someone else needs to deal with systemic challenges of this world. Sustainable investors have a different take. Instead, they recognize that the positive social and environmental impacts that specific investments have and intentionally integrate such holdings into their portfolios. They seek ESG benefits along with their financial returns. They invest in an affordable housing project here, a wind power company there. Their portfolios don't include tobacco producers or maybe even coal mining firms. They ask this company to disclose more data on diversity or that one to improve its safety standards at a supplier overseas. All of this represents progress. These investors see the social and environmental challenges in the world, and they try to keep their portfolios fair and clean. They think allocating assets to a strong ESG performers while generating competitive returns is a worthwhile activity. But how can they get beyond fair and clean portfolios to a changed system? How do they propose to make a difference that lasts? While sustainable investment helps investors to manage ESG impacts in their portfolios, it stops short of helping manage systemic challenges, essentially running the risk of missing the forest for the trees. Now, a growing class of investors, what we at TIP have coined system level investors, acknowledges that they have an impact, whether negative or positive, on the global social, financial, and environmental systems, and that those systemic challenges impact their portfolios in return. These investors intentionally manage the risks and rewards at these levels to provide a stable, resilient foundation for investments across all their asset classes. They set explicit goals for their impact on systems, use a range of techniques to reach those goals, and measure their progress toward them. They seek to preserve and enhance foundational social and environmental systems in the long term while achieving competitive returns. So the book, which lays out a roadmap for how investors can shift their investment practices to meet the challenges of today, is based on the work Steve and I have been doing for the past 6 years with our team at TIP and a range of different investor types and industry stakeholders. And the big idea at the center of the book and our work generally is that investors need to better understand and act on the big picture context of their investments and the feedback loops between their investments and the planet's overarching systems that ultimately make profitable opportunities possible. To navigate this bumpy terrain, 21st century investing essentially provides the what, why, and how of system level investment, what it means to manage system level risks and rewards, why it is imperative to do so now, and how to integrate this new way of thinking into current practice. The 6 key elements of that process are the same for all investors. You set goals, decide where to focus, allocate assets, apply investment tools, leverage advanced techniques, and evaluate results. And for each step along the way, we illustrate the need for and benefits of incorporating a system level perspective. So let's just bomb through that. So to start, investors need to be clear about goals, whether individuals manage their own accounts or institutional investors stewarding the funds of others. Whether they like it or not, investors are either making systemic challenges better or worse, and they need to be on the positive side of that equation. For investors large and small, the next step is determining which challenges are in fact worthy of a system level approach. Each issue needs to have consensus about its importance, relevance to investors across their asset classes, effective means for investors to exercise influence, and uncertainty that cannot be dealt with by today's conventional investment strategies. Next up is allocating assets. Whether an individual or institution, investors should know the social and environmental purpose of each asset class and what role can each most effective play in solving systemic challenges and creating opportunities for all. Investors should ensure that the holdings in their portfolios take full advantage of the purposes for which each asset class was designed. For example, public equities are really great for driving big, long evolutionary change. Venture capital, really great for revolutionary disruptive change. Institutional investors can extend their routine practices on investment beliefs to encompass those dealing with social and environmental systems, vote proxies to exercise systemic influence, incorporate industry-wide issue-specific criteria into active management to address these big systemic concerns, and create customized models that envision systemically new approaches for indexed passive funds. Individual investors can mimic these steps by searching out asset managers that have already implemented credible practices in these areas and are willing to integrate the specific systemic risks and opportunities on which these individuals are focused. Investors need to next step out of their comfort zones by leveraging advanced techniques. Institutional investors can do this by collaborating with peers and other stakeholders to apply pressure on whole industries to address big systemic issues, support governmental regulations on the social and environmental landscape, exercise influence in aligning the interests of conflicting stakeholders within systems, large and small, in creating new financial markets that solve persistent challenges, not simply profit from them. Individuals lack the opportunities for direct participation in many of these approaches, but can request the funds and pension plans in which they are participants to employ these techniques themselves. And lastly, all investors should expect more than the usual quarterly investment reports. Individuals and institutions should ask what managers have done to influence systems positively, and they can evaluate managers' actual goals for a system, the actions they have taken, the changes to which they have contributed, and the progress that the system itself has made. While the challenge of making this transition across these steps to system-level investing may seem daunting for investors and really the advisors that support them, Steve often reflects on just how far we've come as an industry. When he started in this business more than 40 years ago, data was hard-earned. He had to send a postcard through the mail to request a corporate annual report, and a press search meant getting out a pair of scissors in the daily papers. There were no overviews of social and environmental records of the S&P 500, and it wasn't until almost a decade after Dominic created the first SRI index in 1990 that Dow Jones and FTSE for Good saw fit to launch similar products. Now, a firm like MSCI offers hundreds of sustainability indexes, and the Bloomberg terminal includes ESG metrics and ESG disclosure scores. So the path towards system-level investing will depend on who takes what actions. Some investors may start with a comprehensive plan, others may need to take incremental steps. Institutions may adopt one approach and individuals another. Some may work together and others on their own, but their processes should have the same basic 6 steps if they are to get from here to there and all arrive successfully at the same endpoint: management of the complex, interconnected risks and rewards of today. And rest assured, the investment community is catching on to the importance of this idea. Awareness of systemic issues and the urgency needed to address them is increasingly reflected in the heightened concern by investors for responsibility of the stewardship of their assets, one that policymakers and those concerned with corporate governance are gradually integrating the language of systemic risks into. For example, in the UK Stewardship Code 2020, Principle 4 directs asset owners and managers to identify and respond to market-wide and systemic risks to promote a well-functioning financial system. The CFA Institute, the big umbrella here, has also echoed this sentiment. In a recent report acknowledging the multiple interconnected factors that drive the investment ecosystem, CFA advised readers to move beyond traditional ESG practices and into system-level thinking. So today, investors of all stripes have the opportunity to become part of this important transition and early adopters of a transformational movement. Steve and I have been on this journey together for nearly 6 years, and there are many more steps for us to take. We hope you can join us. Thank you.
Thank you. Thank you, Bill. Well, you've given us a lot to think about and a lot to discuss, and that probably seems overwhelming to folks, but you've talked about how advisors and investors need to be clear about goals. What challenges are truly worthy of a system level approach? How do you allocate assets? How do you leverage different techniques based on where you are in the marketplace, and how do you report back? So when we got together and started to talk about this soon, I'm going to start with you because you raised a question that said, I think we need to start communicating and talking differently about what our goals and objectives are and where we're going. So let's start there if we could. Why don't you introduce yourself, and let's start at that session of goals and how we're approaching these challenges.
Great. Thank you, Michael, and thank you, Bill, for such a great introduction to this, and frankly, pushing all of us as advisors to help work with our clients and bring the work and the use of capital, I'd say, to the next level in terms of driving change. So, really appreciate the framework and the introduction. I can see many of the names on the on the attendee list, and so it's nice to see so many familiar names, but also some new ones as well. So for those who don't know me, my name is Dune Thorne, and I'm a partner at Brown Advisory. I also serve as the Chief Strategy Officer for the firm. I've worked in this business with families and family offices for 25 years and started the office here in Boston for Brown Advisory almost 10 years ago now. We manage just about $9 billion here in Boston and about 140 across the firm. Our team here in Boston works with about 150 families, and about 50% of those sort of focus around sustainable systems level investing. So it's been a really important part of our business. The one other piece I might add in my introduction is, my passion and purpose in getting involved in this business 25 years ago was when I was at Harvard Business School and recognized how few women were taking investment focused courses. And so I've really had sort of a personal interest in how we can engage more women in investment decision making. And that led me into this career in working with families and how we engage women and next generation family members into the investment decision making. And I share that to say that there's such a strong intersection point around what I see systems level investing and engaging all family members around the table. Because when you get that range of perspectives across generations, across genders, across those who are sophisticated investors and those who may not be as comfortable around the investment decision making, I think that's where the values and the heart comes into the conversation. And that, I think, is what can really open a new series of conversations around how a family's capital or how an institutional's capital is being used to really connect with long-term goals and drive long-term outcomes and impact, which is sort of what we see as the heart of systems level investing, is how can we use the resources we have to be part of creating that change that's so needed in the future world. And this is a time, I mean, going back to your point on goals, Michael, I'd say more so than ever in the past 2 years in the world we've been living in, with multiple crises, meaningful multiple crises, in the environment we're living in, clearly around climate, around health and wellness, around social justice and equity, around polarization on so many fronts. We are living in such crisis. And at the same time, we're seeing huge wealth accumulation happening with the strength of the markets for so many of the families that so many of us on this call today are working with. And I think those two factors have led so many families we're working with, I know many others are working with, to really take a step back and say, what's it for? What's the purpose for? And what do we want to use this capital for long term? And the question of just our role is to just grow capital is meaningfully changing, because our clients aren't looking for that to be the outcome of just growth of capital. So many of our clients are saying, what is it for and what is the purpose? And the ES&G that we've talked about historically that is now shifting into systems level investing is at the heart of it. What is the environment and the world we want to be living in around social justice, around governance, around environment. So we're really seeing those goals get so much clearer for our clients. And I think so much of this last 18 months and in the COVID environment is bringing these it's escalating the pace of these conversations in a really, I think, meaningful way. The other point that I would just bring up is what I'm seeing happen much more quickly than I expected with the families we're working with is a shift from this idea that Bill brought up of screening out, right? The idea that I don't want tobacco, or I don't want fossil fuel, or I don't want companies without certain diversity on the board in my portfolio. When you screen out, you inherently sort of take out a certain number of businesses or funds or investments from the portfolio. To this dramatic shift to say, creating change is not about screening out. Creating change is about screening in, and about how do we use the right questions to be asking the companies we're investing in around how are they seeing their role in creating change for the future, creating opportunity, not just to make future change around the environment or around social and human rights and other factors, but also to drive financial performance. So what I think is exciting and what gets to this conversation of systems level investing is when we really sort of phase out from this idea of ESG or sustainable investing is over here on one side and traditional investing is here. But rather, how is ESG helping us just be better investors, period? Helping us understand companies that are being more thoughtful about scarce resources or about emissions or about human capital and the importance of the colleagues and stakeholders in their larger network to be better businesses, to have more stable supply chains, to have more stable employee base and colleague base. So that is getting, I think it's moving quickly, and it's exciting to think about how ESG investing is just becoming good investing, because on a systems level, it's helping us find better businesses that will not only have stronger financial returns, but also have a stronger impact on the world we're living in. So why don't I pause there? I know there's some just incredible panelists who have so much to share, but those are a few initial thoughts. And actually, I'm sorry, one more thought to add, and then I want to pass the baton, is that another change I'm seeing so much is the collaboration across the industry, that our industry is known to not be collaborative, known to be competitive, known to think about one firm or another firm, but not together. But it's incredible to see whether you think about Climate Action 100 or Science-Based Target Initiative or the Task Force on Climate-Related Disclosures, the list goes on. How many firms are coming together to share information, to work together in partnership. And that's where systems level change happens. So I think both the work with our clients is important to acknowledge, but also our work with each other on this call and how we can collaborate, share our resources, share our thinking, and together as an industry, be part of driving that change.
So that's going to give us some great fodder to move forward. When we were preparing for this call and we talked about this, Kim, you talked about the fact that for many investors, the idea that systems matter is just something that people don't get, and that where we are currently isn't getting us there. And I know you represent clients that are where Dune's clients are, but also clients who are in a different place. So let's take that from there and have you give us your thoughts on this.
Yeah, I thank you, Dune and Bill. You did give us lots of things to think about. Our firm, Boston Trust Walden, manages about 13.6 billion in assets, and we are known as a real ESG firm too. About a little under half of the assets we manage have ESG criteria. They impacts all the portfolios we manage, but screening criteria are incorporated in about half of our assets. And we also take a very, very active shareholder engagement role for those clients across all our client base, but especially for those who have requested that service from us. And Dune, I was really interested in one of the things you just said, which was like, we're kind of moving away from hard screening. And I think for a lot of clients that may be the case, but for the clients I work with, screening is every bit as much still part of their concern. I think for many clients, they want to not profit from certain enterprises, and it might be weapons. If it's a school endowment, they don't want to have like assault weapons in their portfolio, tobacco for a healthcare enterprise. So obviously mission alignment is really important, I think. But there's also a question that I think all investors maybe want to think about when they're investing, and that is, in what way could I possibly influence the company? So like, it's important to engage with discussions with corporations in ways that are meaningful for both parties. And I don't think it's possible to talk a company out of participating in the enterprise that they were founded to participate in. So I don't think you're going to get Altria to stop selling tobacco, because that's just too central to their corporate identity. But we might be able to talk to Hyatt Corp about their makeup of their workforce, and they recently disclosed EEO data on the basis of some engagement that our firm had, and that's a real step toward understanding the makeup of the not just the board, which you can open up an annual report and see, but the real leadership of a company. So that would be and so one of the things we do as a corporation is we ask for more transparency. We want to know, what are you doing about this? We ask for commitments around sustainability. So we want companies to adopt science-based targets for reducing their emissions. And we ask for, commitments around governance. Would you consider changing your nominating charter for your board of directors? And so we're very much involved in that. We're also involved in some public policy work. If other firms are looking at this kind of work and saying, how can I get more involved? What can I do to be part of the change? Which I think is the whole purpose of this conversation, is not just to inform, but also to help people jump on the bandwagon with us. And I would say at the very least, reviewing your proxy policies or those of your managers, if you're a manager of managers, then you just to make sure you're supporting resolutions calling for more transparency and accountability on these really important matters, especially climate, because if we don't get that right, nothing else is going to matter. So if it's not a livable planet for all of us, and I think that's really the overarching takeaway from this conversation is we as investors often make assumptions that things will go on as they have. And if you read any of the science around climate, there could be very disruptive changes that happen much more quickly than I think the assumption is. And we really need to all be pulling together on addressing climate. I think that social justice issues are also extremely important. But the climate one really gets my attention just because of the fact that the very food systems and weather systems, those are the kinds of systems that will absolutely 100% impact all of us. So I'm going to stop talking there. I think I've not overshot my time limit, but I'd be happy to answer questions, but I'll cede my time back to you, Michael.
Okay, so let's take what you both have talked about, and I want to turn to Nakia now, because one of the questions that you raised and we all talked about is, so how do we help our clients get there? And Nakia, you're in a different place. You have a larger firm. So tell us about what you do and what your reaction is, what you've heard so far.
Sure, great. Thank you, Michael, and thank you all for participating on the call. For background, my name is Nakia Maddox-Eubanks. I am a wealth manager at BNY Mellon Wealth Management. I have the opportunity to manage assets for families, individuals, endowments, and foundations. We talked a lot about ESG investing. We talked a lot about social screening, shareholder engagement. And so, it's been a bit of an acronym soup as this field has evolved over the decades, right? And so, our approach really is to focus on the evolution of it. And so, we talk about ESG. Our approach is really focusing on responsible investing, right? And with that, there's a four-prong approach. We manage ESG screening, social screening, we manage thematic investing and impact investing. And we've had the opportunity to do that while managing $7.5 billion in assets under management in this field, and have had the opportunity to develop investment strategies and work with our clients over the last 20 years. So, in building on what Dune and Kim have discussed, it's really evolving, and as we all are participating in the evolution of this field, right? And really working with our clients to align their passion, mission, or values with their portfolios. And so, it's an opportunity to really think about, what they're interested in and what their giving is, and to align those sort of goals with their portfolios.
Terrific. So now each of you has talked. I'm going to turn to Rick, because Rick, you're doing something on a different scale. And one of the things we talked about is, how do you move this to scale? So why don't you tell us about what you're doing and how that plays into what we've heard so far?
Sure. Thank you, Michael. And thank you, Bill, for the introduction, and to my fellow panelists. This is an interesting conversation. So by way of introduction, my name is Rick Smyers. I have been at Fidelity Investments for over 15 years now. And in the last 3 years, I've been leading the team building Fidelity ESG Pro, which is a software platform for sustainable investing. And, in reflecting on the topic here of systems level change, one of the reasons that we decided to build a software platform rather than launch a new fund or build a ESG portfolio was that we thought that we could have greater reach by building software. We talked to a number of the experts in this field, folks like my fellow panelists here, about how they approach sustainable investing. And there were some real challenges that they had to address in the early days. How do you explain this to clients? How do you find investments that are truly sustainable? How do you explain things like proxy voting and shareholder engagement to an average retail investor? These are not trivial challenges for a mainstream advisor, for folks who haven't spent decades learning this. And so our goal with our software is to help walk a novice advisor through all of those steps, understanding the goals that the investor might have, prioritizing those goals, finding investment solutions that align, explaining what you've done back to the retail investor. And so our goal is to help ESG and sustainable investing go mainstream by educating thousands of advisors on how to do it. And hopefully with that, they'll have tens of thousands of clients who are investing in this way. And that could have the potential to drive the systemic level change that we're all seeking. So that's kind of my angle on this. It's I am not the expert that all these other folks are, but we're trying to capture their expertise in our software, package it up, and then deliver it to the mainstream.
Terrific. So Bill, now you've heard from our four panelists here and what they're doing and what they're trying to do. And so let me ask you to reflect back based on the work that you're doing on moving these system level investing ideas and the folks you've been working with. What's your first bit of advice for them or your question back to them?
Yeah, so it's an interesting thing because I think whenever we have this conversation, I think everybody's starting point is slightly different. And I think that's a manifestation of either the types of platforms they're affiliated with, the institutions that they represent, or the type of clients that they serve. So this, generally speaking, it's like when we talk about taking a systems focus, one of the best ways that we can describe it is really just in terms of how you begin to measure progress. And so if you think about most of the industry where it's at, it's the idea of we're measuring the impact of a specific portfolio. And that's what your focus is, right? Like I have a greener portfolio, I have a more socially responsible portfolio, and I can demonstrate that progress based on these metrics. The second kind of step change came about a couple of years ago when, the Sustainable Development Goals from the UN really started to become popular. And all of a sudden people are starting to not just measure the impact of their portfolios, but they're started measuring the alignment of those portfolios with some of these broader goals. And that was like an interesting step towards a systemic focus. But we were introducing on top of that, and I think it was a comment that Dune had made around the kind of collaborative action aspect. And it really gets into measuring the influence of that impact, influence of that alignment. So it's not just saying that, oh, fresh coat of paint, we also, because by virtue of this portfolio being greener, it now is tied to SDG 3 on climate change. We're actually looking at what is our contribution as an investor towards the gap that's needed. And then what is our contribution to influencing the behavior of other investors to really drive change within the financial system as a lever for driving change within that system. And so I think one of the things that I'd be curious to hear from each of the panelists is in the context of the types of clients that you serve, how do you begin to start to bring in some of that thinking? And how do you begin to kind of go through discovery? And how do you begin to actually knit together solutions, right? Because it's a slightly different value proposition, as we've talked about. It's not just about allocation of assets. It's about thinking about really as a firm, what are you doing to drive that bigger change? And I'm going to just point to Nakia first because I saw her nodding along. So you're fired up. Go jump on in.
Yeah, thanks, Bill. I appreciate that. So, it's really a discussion base, right? It's not one box fits all for investors, right? Because everyone's values are different. Everyone's passionate about different things. So it really is an opportunity to listen. As practitioners, our first priority is to listen to our clients to understand what they need and what they're not interested in. And oftentimes, that will require due diligence and really extending conversations to understand, it may be a frontline headline that really sparks the conversation, but there's a target somewhere in there that they really want to focus on. So questions to consider is what's important to you? Where do you, provide your gifts if you make any sort of gifts, speaking specifically to families and individuals? What matters most to you? So you start really general, right? And through those conversations, there are nuggets that can develop into a strategy or a theme that could really help us at BNY Mellon really present opportunities for investment or establishing an investment policy statement for opportunities for investment. So it really is collaborating with our clients to better understand who they are, what they want to focus on, and what matters to them most.
Anyone else want to weigh in?
I follow Nakia because I just couldn't agree more with your points. And I think particularly in this time in the world, it's reminding us so much as advisors. And with this group with CFA backgrounds, we all know that the data, the rigor, the analysis is so important to our work. But this is also human. And that we are managing money for families and institutions that are serving people, and our global society is made up of people. And so I just love your points around the importance of listening, the importance of asking those questions. I think we've really focused a lot as a firm and talk about actively how the first question with every client has to be, how are you? And what's on your mind? I think to your point again, what matters most to you? And it's really incredible to hear the responses. It's rarely, did my portfolio outperform the blended benchmark? Or was my volatility X or Y compared to the market? I mean, it's rarely those quantitative pieces. It's much more often, I'm worried about my children. It's much more often, I'm really worried about what's happening around climate, or what's happening around justice, or what's happening in my local community, or wealth divides and polarization. That's what's worrying them and keeping them up at night. So it's the perfect door opener once they share those goals to really shift the conversation to how can we help you use capital to help drive that impact you care about, or help create a comprehensive, thoughtful plan to support your children and the stewardship and responsibility of managing wealth into the next generation. But it enables them to open the door to be open, I think, for a deeper level of conversation. That's what we need for systems level change. So two tangible pieces I just had written down as you were talking, Nickys, is one of the best practices we have developed that I've really seen resonate well for clients that may be helpful for others is really trying to move away from bringing big books of data into meetings and sort of opening a meeting with a big book that's 50 pages with just tons of data on a page. But we're really starting with skinning things down a lot more and having an opening page always be our understanding, which is essentially what we've heard from the client over the last series of meetings we've had with them. What have we heard their goals to be? What do we understand some of the transitions they're going through right now? But really being a few bullets that are our understanding of where they are and what matters most to them. And then it gives them a chance to say, gosh, that's exactly right. You've heard me in the right way and you know what's on my mind, or actually these goals have shifted, we're in a different place and here's why. And so I think that's hard for us as analytical people who go to the data. Like I'm the first one to say, if I don't know the answer, I go to the data. But instead we now need to, I think, move away from the data and open those conversations. The other thing that we've really tried to focus on doing is instead of having the impact reporting be at the end of the deck, to move it to the front, to say, here's what we've heard and here's your understanding. And here are how the capital that we are managing for you is driving the impact you care about. So sort of starting there and then having the asset allocation and the risk return parameters sort of be the backup to that, but it flows a little more smoothly to say, this is what you care about. Here's the impact your portfolio is driving, and then here's the data around the metrics to support it. So those are just two tangible things that may be helpful.
Can I get just really quick? So I want Kim to react next. And one of the things so from the teasing out investor interest and going through that discovery, super important, right? The thing I want to get into, and maybe you can come and opine on this, is what we're talking about is a different scale of opportunity or challenge, right? Like we're no longer talking about the love canal, like a river burning. We're talking about melting polar ice caps. It requires a different set of solutions. And that's part of what we're trying to get across the book. So I think what Nakia and Dune have interrogated right here is, okay, how do you get through that kind of discovery process to really tease out, okay, what are those issues that you really want to focus on when you're saying this? But I'd love to just push Kim a little bit on, so what do you do with that information? Like, how do you begin to actually start to reflect that greater ambition or greater complexity back with the solutions?
Yeah, it's the question, right? So I think we've been talking about meeting your client where they are and really listening to them. And I think that any good advisor needs to do that at a very minimum to really understand what matters to them and make sure that you're responding to those needs. But systems level asset management, at least my understanding it is going beyond just building a custom solution that is something that they feel good about, right? To actually, how do we tackle this huge like oncoming train? As how do we as an industry lend our weight toward real, truly systems level change where the risk to all of us is captured? How do we also create a fair society where everybody has, you know, truly a shot, right? Because what we have right now is one where some people think we do, but we really, fairness and equity is really not uniform. So, and do we all agree that those things are desirable? I think that's obvious, but maybe some folks aren't as convinced. I'm confident some folks aren't as convinced. I'm going to just stick with climate because, as I noted, that's a thing that if we don't address that adequately, we will all tremendously suffer. And we may be a little bit late to the party in that anyway. So you asked the question, I think, Bill, like, what are we as a firm doing to try to tackle this issue? We, of course, are building portfolios that are fossil fuel free and some that are incorporating, as you mentioned, you know, renewable energy stocks. So that's like the individual portfolio level stuff. But as a firm, we are very active with Ceres and other investors with the Climate 100. So really attacking the problem from the demand side of the equation and saying to companies, we need a promise from you that you'll start to measure and manage your emissions and climate impact. And we engage with companies on that topic at great length. And so we raised it over and over again as an issue. We've also pushed even the fossil fuel companies. Walden was involved in getting a resolution on Exxon's ballot around corporate lobbying and asking them a really pointy question about, like, would you please share with us how you're engaging with our government on the issue of fossil fuel regulation and carbon tax, things like that, things that we really kind of need to know as investors around risk. So I would say our company is super involved in these areas, and we're very active and have, you know, done our best to really to take these systemic risks head on. The last thing I'll say before I'll wrap it up and maybe give Rick a chance to talk is we also engage in public policy advocacy. And that is also, I think you mentioned this, Bill, in one of your comments, was like, if regulation is a lot faster than talking to companies one by one. So if every company had to disclose climate risk in a way that was uniform and maybe more comparable across industries or across companies, then that would be a big game changer. It'd be a lot faster than like talking to companies one by one. I also think there's going to be some regulation of our own like ESG industry that the SEC is talking about, like outing us if we're opposers. And I think that that's going to happen. And we need to prepare and make sure what we are saying and what we are offering really lines up with what we are doing. You know, you can walk the walk, but you know, you got to walk the walk. You can't just talk the talk. So I think that change is underway, and I'm excited about those changes. And I hope they're in time for all of us and all the people on this call. And that's where I'll stop.
Can I ask Rick? Sorry, Michael, I don't mean to be still, but just
Rick was all ready to go. I could see him.
Yeah, I have a question. So definitely want your general reaction, but I think if you can touch a little bit on, so as we've been talking about this and these different steps in the process, whether it's around discovery, whether it's around the actual recommendations, the set of solutions you're providing, for the ESG discovery stuff that you've developed for the portfolio construction tools, you know, when I talked about that measuring impact, measuring alignment, measuring influence, to what extent, I know it's early days, but to what extent are you guys considering some of the alignment aspect, the influence aspect, some of the things that Kim was just talking about, the engagement with policy, things like that, that ultimately are going to drive that bigger change.
Sure. Yeah, I was thinking through some of those exact questions as the others were talking. I think it's the first thing is going back to the way Nakia opened, really understanding what your client's looking for. That's the first step, and that's what the first thing our tool does, is help an advisor understand what their client is really looking for. And there's some subtleties in this that some people might not appreciate. I think it was Kim who said, I have certain clients that don't want to profit from a certain industry. And that's a very different mindset from somebody who says, I want to change a certain industry, right? And we call the first one the alignment mindset, and the other one's the impact mindset. And if you're talking to somebody who has the alignment mindset and you're telling them all about your impact, it might not resonate, right? And on the flip side, if you're talking to somebody who really wants to create change, and you're giving them the pitch about how you're going to generate better returns and reduce risk through use of ESG data, you're just going to be passing in the night, right? There's no connection there. So it's really it's important to understand not just the causes and concerns that your client has. Do they care about climate change, or gender equity, or social issues, but also, what is their motivation? Are they really looking to create change? Are they just looking at this as a better way to invest? Are they looking to sleep better at night? Right, the really different motivators. So it's important to understand those things first and foremost. Then, if you do have somebody who's an impact seeker, as we call them, that's where, Bill, to your question, how do you prove that there is impact? How do you demonstrate that there really is impact with a certain way of investing? And there, I think the proof points are some of the things that Dune and Kim were saying. Stories about shareholder engagement, stories about proxy voting records, stories about collaboration across the industry that actually are driving change. Those are the things that'll resonate with an impact seeker. But I would caution the audience, not everyone that you're going to talk to is an impact seeker. Probably, based on our data, it might be 20% of a retail client base is an impact seeker. The biggest portion, what we're finding in the mainstream investor community, is what we call the alignment seeker. My little portfolio is not going to change the world, but I'll sleep better knowing that I'm not profiting from selling, weapons or tobacco or land mines or something like that. So really important to understand where your client's coming from before you give them that pitch.
It's such a great framework, Rick, that you just laid out. One piece that got me thinking about that we've seen, and I'm curious if some of the other panelists have seen something similar, is, historically, we really saw clients think about had a philanthropic bucket that were sort of the philanthropy that they were focused on driving change with and making grants with. And then there was the investment pool that had a goal of the most return per unit of risk. And what we're seeing is, for that impact category you're describing, Rick, sort of a blending together now of the investment portfolio and the philanthropic assets to really look at, if we care about impact, and again, to your point, not every client is saying that's what they care about, but for those that are, they're really saying, how do we use our combined resources, our financial resources, our network resources, our human capital resources to create that impact? There's certain impact that needs philanthropy to be driven. There's other impact that can be driven through investment capital. There's other impact that can be created through advocacy and through regulatory change and all the things that were mentioned by other panelists. And so I do think I'm seeing that sort of coming together much more so now than a few years ago. And I'm curious if others are seeing the same thing for that impact focused investor.
So would you say, and I'll just, whoever wants to answer that, you are seeing more interest, even if they don't know the words, in this system level impact? Because sometimes it's not really, the idea is out there, but somebody needs to express it in a way that clients say, yes, that's what I was talking about. Are you seeing that? Do people think of things like inequality, climate change that way? And then how does that, how do you respond to that?
Yeah, I'd say one group of investors that we have found are maybe that they don't believe, like I said earlier, that their little portfolio is going to change the world. But if the advisor can explain to them, well, combine your portfolio with a million other and show them some of the data, trillions of dollars are flowing into sustainable investments every year. If you're part of that trillion, that's going to get some attention, right? That has the potential to create some systemic change, even if you're, very small portfolio, relatively speaking, won't. If you can be part of that movement, if you can support asset managers and investment managers that are striving to make those kinds of changes, then you do have the potential to join that movement. That's language that resonates with a certain type of investor we call the expression seeker. Being part of a movement is a really powerful motivator for some of them.
I would just add, I think the question, as I heard it was, are people becoming more interested in systems level change? And I would say people, we're as Dune pointed out, we're human. So I think that there's almost, you have to have an experience to make you a little bit more exercised about some of these issues. I think the George Floyd murder made a lot of people much more exercised about, equality and equity and racial justice. That was like a moment for many people where we're like, I think people really paused and thought about that. I know as a firm, that was a real important, although we've worked on racial justice and equity for a while, that was something that was absolutely something that made us all stop and think. I think on the climate side, folks are very much, if you live in California and the fire season has gone from being a short period to being months and months and months, and you're seeing the devastating impacts of the drought there, that gets your attention in a way that other things might not. And some of the the flooding that's happened, some of the more catastrophic weather events, I think, are getting folks to stop and think about climate in ways that maybe they hadn't before. So in our practice, climate certainly is something that's also getting quite a bit of attention, and people are interested in having long-term impact, not just alignment. I see our client base becoming more on the impact side.
We're seeing a combination. So it's really, kind of combining Dune's experience and Kim's experience, where clients are moving from just philanthropic giving to aligning and impact investing in their investment portfolies for various reasons. It could be events that they have experienced or have read or have seen and experienced over, a certain amount of years where it matters to them, right? And sometimes it takes that experience to multiply over years, and experiences that, lay dormant, and all of a sudden they read a headline in the news and they're like, okay, I can't do this anymore. I want to focus and align my interest, my passion, my giving, where my assets are. So it's really a combination, not just philanthropic work, but the impact that could be made available in their investment portfolios.
So, we talked earlier about asset classes, about, individual equities, and about funds, and about engagement in different, levels. Could each of you talk a little bit about how you think about the different tools that you would assemble to respond to a client, whether it's individual stocks, it's funds, it's, where their passive part of their portfolio is, and ensuring that that's actually engaged? Let's talk a little bit about that, because I think that's something that advisors struggle with. I've got a portfolio that covers a lot of things.
I'm happy to jump in to start, and I know others will have great comments to add. As I think we've all touched on, every client is different. So there is not one size fits all or one portfolio construction that makes sense. So it's just, like we speak about so much in our industry, you truly have to have deep knowledge and expertise across a wide range of asset classes, investment options, investment solutions. But I'd say some of the themes we see that are clearly not relevant for every client, but are relatively consistent, or if we were to say what were some themes be, is that we'll tend to see themes around a bit of, I'd say, a barbell around what I'd say the systems level versus the alignment that Rick had laid out so clearly, where when clients are focused on impact and really care about that impact, we tend to see that being more driven by both the fixed income side of the portfolio, where you can have very direct project specific bonds or debt that can be focused on supporting a certain conservation project near where they live, or a school that they care about, or specific green transportation in the city they live in that helps drive impact. Or we're seeing it on the private side of the portfolio, where can be really focused on private investments driving innovation, whether it's in wind or solar energy, or in battery, or in a whole range of different sort of social justice related equity focused opportunities. So again, there is absolutely impact that comes from the public market side as well. And I think particularly in Kim's point around the advocacy and the collaboration around shareholder engagement is such an important way that we're seeing that done. But we see for many families, they focus on alignment in the public equity side, and with the engagement coming from the shareholder engagement aspect. And then we see a stronger impact focused on the fixed income side and on the private equity side.
Yeah, I'll just jump in as well. I think everything that Dune said, I agree with. The point I would make is that, obviously, as you start with an ETF type structure, index, passive product, and then you move to more of an active or thematic product, and then maybe you move to a really customized SMA type product, you're able to get more granular. You're able to get more, precise in your ability to align with what your client wants. But you're always going to have to draw the line somewhere. It's never going to be perfect. And so as an advisor, I think we've noticed that many of our advisor clients worry that, I can't find a fund that exactly matches what my client wants. So maybe I should do an SMA. But then if you look at the SMA, you're still going to have some gray areas where, well, does this company exactly align or not? Does it count? Does it not count? At a certain point, you're going to have to decide, I've done all I can. This is going to be a good starting point. Let's move forward. And so I would just, again, kind of caution the audience, don't try to find the perfect solution. It doesn't exist. Today, no company is perfect, so you're never going to have a perfect portfolio for your clients. Get comfortable with the idea that you're going to have to do the best you can today, and then improve over time and communicate back to your client about what you can do today and where you're not quite confident that it's perfect, but you're going to work on it and it'll get better over time. You can get more and more granular, but it's still going to have shortcomings at some level.
Rick, very good point. And I echo your sentiment. There are no perfect people, so there are no perfect companies. And that's something that I enjoy having that discussion with those who are willing to engage. And so I think the point that is very helpful for those who are interested in investing in this space is diversification. So we talked about equity exposure, fixed income exposure, private equity exposure, and SMAs, mutual funds, ETFs. To know, 30 years ago, we didn't have a built out platform of mutual funds, ETFs, right? This has evolved over time, and it's all driven by investors who want to invest in this space. So the evolution of it is primarily driven by clients. And so, we're listening and we're acting on their requests, right? And so I think that's the beauty of it, understanding that we don't operate in a perfect world, but listening to them and being able to align their impact or align their goals and their passion with impact or alignment in the portfolio construction to make that available to them really will continue to build out the space.
I would just add, so I think I heard the question is like, what are the tools of the trade for our firm? We eat our own cooking, as my hero Warren Buffett would have said. So we have mutual funds that we offer for smaller clients, but we generally use individually managed portfolios. There's no question that, I always figure if I made everybody a little bit miserable, I'm probably doing a good job, in the sense that you can't make everybody happy all the time. And there's always something like, well, I don't like this firm because of that. And I would just suggest that folks think about, and what I talk to clients about is, do you think we could influence this company? It has this attribute that you find abhorrent. Do we have any possibility of engaging on that topic and getting them to change? So a lot of clients don't like Mickey D's, McDonald's, like they would find, and there's plenty of reasons not to be that excited about their business model, in terms of like nutrition. But if we're able to get a company as big as McDonald's to switch from the polystyrene, boxes for their sandwiches to just paper, it has a huge long tail in the waste stream, because you've eliminated a really odious waste product and replaced it with something significantly more benign. And so, and there's plenty more to do with McDonald's. So, I'm sure there's plenty of other topics to engage on, but that's just a simple example of why it's sometimes worthwhile thinking about influence, something that I think we all have talked about. And how might we get companies to move forward with true systemic change? How can we get these companies to really support some of the important things that we're trying to tackle?
I want to ask a follow-up question there. So we did a body of work a few years ago with Money Management Institute, a bunch of different other players, really focused on financial advisors, and basically saying, as an advisor, you've got these different steps in your process, and here's how you begin to integrate sustainable investing into preparation, discovery, recommendations, management. Great, wonderful. But one of the things that really came out of all the interviews, I mean, we were as much talking to Envestnet, LPL, and advisors affiliated with them as we were, Morgan Stanley, Bank of America, go down the list. And one of the things that came forward with so many advisors was like, look, at the end of the day, I'm constrained by what's on my platform, what I can actually offer. And I think as much as we're talking about now about how you can start to capture these dimensions that go beyond asset allocation to kind of capture, what are you doing to influence policy? What are you doing to influence the data infrastructure that we're all going to be drawing from, and so on and so forth. Going back to, though, the actual types of opportunities, to what extent are you guys seeing the opportunities to go deeper and provide more options around industries that we would consider kind of systemic in nature? So take an industry like the circular economy, that whole movement to go from a linear model of consumption to one that's regenerative by design. In those value chains is so much of this kind of systems dynamics, like embedded into how products are built and distributed. And I wonder, to what extent are you guys actually finding opportunities that you're able to actually provide on to clients? Because I think Kim's point is exactly right. Like, at the end of the day, the big ball game is moving the super tankers. That's why Climate Action 100 Plus is focusing on the biggest emitters. But then also thinking about some of these other other types of thinking and approaches that can be brought in, because I think exactly, Kim, what you were suggesting is circular, it's like trying to get them to shift their packaging. So what extent are you guys finding those kinds of opportunities to be able to provide to clients? And how early days are we in really identifying those kind of systems industries of the future? We stunned you into silence. That's exciting. And it could just be early days.
If you go back to the threads we've been talking about, there are so many important tools in the toolbox that are needed to do this, and they're continually evolving and changing. And I think, the first part of your question really resonates for me in terms of the challenge for as advisors, our clients look to us to be experts, to bring expertise to the table. And the reality is, this is a space that has so much change happening in real time that it's hard for each of us to be an expert on all of these topics. And so the importance of education, the importance of having expert resources to tap into, to pull in, and I think the importance as advisors to acknowledge we're learning together. And that's not something that most advisors are comfortable doing with their clients, is saying, I don't have all the answers, and we're learning together on this. And to create this change around climate or other areas that we're talking about today, we have to commit to the learning journey together and know it's not going to be perfect each step of the way. But I think to your point on the company research is that we're actually finding in a time when there's been such a move towards passive into using more passive structures or quantitatively driven investment opportunities, that ESG and systems level investing is actually moving us back towards credible opportunities and fundamental bottom-up research. Clearly top down from the systems change standpoint, but from the company research, how do we use research to identify companies that are thinking on a systems level, or thinking from a circular economy standpoint, for looking at, how do they look at their whole supply chain, the transparency of their supply chain and the impact that it's having long term. Or I think what's so interesting now in the past 18 months is human capital, and how important the complexity of stakeholders are for a business, and thinking about not just their employees, but clearly their clients, but their supply chain and the human capital in their supply chain, and how that has to really be thought of at a systems level to lower risk, to think about long-term sustainability for their business, because most businesses are so dependent on human capital and the quality of that. So what we're seeing is our fundamental bottom-up strategies like large cap sustainable growth managed by Karina Funk and David Powell. We've seen huge inflow of assets there because of that bottom-up fundamental research they're doing to identify companies just as you described. And 5 years ago, we often got the question like, why would we invest in a passive vehicle? And now we're seeing such a focus on wanting to know the underlying companies and portfolios. It's not to say that passive and quantitatively driven strategies don't have a role and place in a portfolio. I think particularly around that alignment topic, we were speaking so much about earlier. But the systems level, I do think there's a role for fundamental bottom-up research that is becoming so important in driving that change.
I think what has remained consistent over the years as ESG, responsible investing, the acronym SOUP has evolved, is the due diligence, right? To be able to exclude investments from your portfolio, you needed to do the research to understand what the companies were about, where they align with your values, your mission, your passion. And I don't think that has changed over the years, although this market has evolved. And so, I do agree with what Dune has stated, that it's the due diligence, it's the research that really adds the value. And that's where we're seeing, the most importance and the focus on, what matters to our clients the most. So that is something that has really maintained its identity over the course of the evolution of ESG, responsible investing, impact investing, thematic investing, things of that nature.
Yeah, I'd just add that there are only a couple of areas where this has become more mainstream and scalable. I think climate is one where it's getting there, where there is an infrastructure to report on climate-related metrics. It's not perfect, obviously, but it at least exists. And for gender metrics, you can at least find out the composition of the board of directors of public companies. If you want to find out the composition of the management team, that's a whole different story. You probably aren't going to find that in a big data set. And then beyond that, to things like the circular economy, Dune's exactly right. It's got to be one at a time, bottoms up, go talk to management, dig in. There's no comprehensive data set that's going to help you with that. Then to create an index or something like that, you're going to have to do it one at a time at this point. But again, it's constantly improving. In 10 years, hopefully there'll be a different story.
That said, let me pull a couple of threads together and ask you. You talked a little bit about this, and I've seen this a lot and heard from people a lot. The idea that this is more active. It really enables people to want to come to you. Even within that, though, you're dealing with passive elements of a portfolio. Everyone has those. And that's where the engagement comes in. And that's where what you as a firm might do, but also what the larger firms are doing. I think everybody out there has seen what a BlackRock and what some of these firms are saying that they're doing. It seems to me that there is a role here for two things in the reporting. One is reporting back successes. Kim, we were talking about polystyrene, but there are successes with engagements in industries. And then there's also the question of, going back to clients and being able to say, these are some of the asset managers we're using for pieces of the portfolio because they do, not just because of the composition, but because they are engaged. Is that something that's happening? And how would you advise folks to think about that and to perhaps begin to bring that into their reporting and their discussions with clients?
I can just say that, because we've been an impact firm for over 40 years, we're the grandmother in some ways of a lot of this engagement work, starting back with apartheid, frankly, in the 80s. So we've been doing this a really long time. And our firm produces a quarterly impact report. It's always on our website. You can download it. You can see the kinds of things we're working on. And we do a big annual update. It's a huge part of the reporting that goes out to our clients. And Dune, I think you mentioned moving it up in the book, and I'm thinking, but there's an assumption though, if you're working with us, that this is something that's important to you. So I also know that clients can access that directly. I do. I was a manager at State Street, first at Bank of Trust and then at Global Advisors for a decade. And it was just a very different environment there to be practicing this work. And it's a very big institutional asset manager. It was at the time when I worked there, and it's, I think, much bigger now. And there's a lot of competing interests within a really, really big firm like that. I think what we're seeing that gives me hope, because I understand if you're running a big complex business, it's really hard to maybe take on systemic investment, as an issue. Although, if you're the richest company at the end of the day, but the rest of the world is dead, it's not really a victory. It's kind of a hollow victory, I think, in that sense. So, but what we're seeing finally is larger firms are starting to vote along with little guys like us, or gals. I hate that word, by the way. Little people like us. So we've only got 13 or so billion. It's not a lot. Apple doesn't shake in its boots when they see us coming, but they do kind of shake in their boots when they see BlackRock voting their proxy. Not that they're any better or any worse than anybody else, but it's just really hard to have a big voice with some of these mega companies. And if we can get those larger asset managers, and I'm talking about you, Nakia, BNY, to vote along with us, then I think we really might have something. And I think that a proxy is it's surgery with a butter knife. Just to be clear to everybody on the call, it's not precise. Proxies, shareholder resolutions are non-binding. They can be challenged at the SEC. They may not even make it onto the ballot. And that happens to us sometimes. But if there's one on there and then I would ask everybody who's listening is to ask your firm, are we supporting resolutions around climate at the very least? I would think we could get a lot of consensus around the issue to say that, we want a world that can sustain life past 2030. That's a reasonable goal. I think that's something that we all should be striving for. I think there should be some unanimity, no controversy around that. And yet we don't get support of 100%. We're getting better. As I mentioned, that ExxonMobil, we were 62% on that vote. So it passed. Now, ExxonMobil can legally totally ignore us. So it's not it's not even that pointy a weapon. All we have is embarrassment. It's really not super strong, but at least it's something. And I think that it's if we could get more unanimity around some of those major issues, that would be a success for me.
Reactions to that?
Well, Kim, thank you for the shout out. I do appreciate it. I will say that we do participate in shareholder engagement, although there's always opportunity to dig deeper, right? And I think what's most important for us is to really help our clients understand this space, right? Because once you start asking those questions, as Rick spoke to, you know, you think they're interested in one topic and they're interested in another, right? So the end goal is not just to align their investments or impact in their portfolio, but to dig deeper into the shareholder engagement of which we do participate.
Well, one of the things we think a lot about with shareholder engagement, because I so agree with the points raised, that it's such an important tool and movement to really drive this change, is that at the end of the day, these are not our assets. These are our clients' assets. And so there's an important role we play as fiduciaries and stewards for our clients to go back to some of the earlier points about listening to what their goals are, and then as an industry helping create the flexibility to implement or to allocate, to vote, to be stewards for those clients' goals. And where one client may feel strongly, you look at a topic like stem cell research, we have some clients that feel very strongly in one direction, others that feel very strongly in another, all with a focus on mission alignment. And so, this is an area where I think some of the technology advancement, I know, Rick, that you're working on and Fidelity's working on, and so many other firms, really enables us as advisors to do that customization for clients, so we can vote in the way each client wants, not as just one big pool. Because the reality is these are our clients' assets, and they have different goals that we need to honor as fiduciaries for them to drive the change that they want to see and be systems level investors. So I really think it's an interesting time where these important global crises are bringing really key issues to the table and creating the space to more clearly talk about goals. And at the same time, technology advancement around separately managed accounts and around the ability to do like carve outs around trading and proxy voting is really exciting, because we won't have the excuse anymore to say we don't have the ability to vote proxies in alignment because the assets are pooled, but you can really separate them out because of the technology tools. And I think it's exciting to see those pieces coming together that will really help with the systems level change.
I think, kind of following up on Kim's point, that there actually may be a moment here where that we could get the whole industry working together really well. If you're a smaller firm and you want to get attention and get clients, creating some shareholder engagement stories that are really powerful is a great way to do that. And I think we are at a moment now where BNY and Fidelity and State Street and BlackRock are going to pay attention to those resolutions when they come up. In the past, perhaps there wasn't as much attention on voting records. Right now, there's a very strong attention on that. And so when a resolution is raised, even if it's by a tiny firm, the big guys have to pay attention and will pay attention. And so I think there could be a moment now where there's a real symbiosis there, that the smaller firms are engaging and creating these opportunities, and the bigger firms that have all the voting power will come along. So there could be a good opportunity for collaboration, whether it's intentional or not. It looks like it's starting to happen.
That's terrific. As we get ready to wrap up, why don't well, Bill, maybe I'll turn to you to see if you have a question. I guess my wrap-up question would be to Dune and to Kim and Nakia and to Rick. So for folks listening to this or watching the recording later and coming to this maybe a little newer, we talked about a lot of things they could do, but what would the first step you might recommend to someone who's heard this and said, that really sounds interesting, it sounds like something I would like to try to have this conversation with my clients about? What's the first step you would recommend?
I think it goes back to the first point that I raised at the top of the call, and really just to listen to what interests the client in this space, right? And from there, shape it based on, how we recognize it, how it has evolved. The evolution of this space is important because it will continue, but to start with exclusionary investments, to impact investing, you know, there's a few decades at least in there, right? So to explain the history of this part of the market, I think will be important to share with the client because it's not new, right? And over time, there's been this myth that you have to sacrifice returns to be in this space. And I think that started with exclusionary investment. If you have, you know, a concentrated portfolio, you sacrifice returns. So to really first listen to your client, to understand why they're invested in the space, talk about the history of of responsible investing, and kind of shape and form based on how, as practitioners, we identify in this space, I think would be a helpful start.
I might just add on to exactly what Nakia said, and just sort of add on to, I think it's something so important that we can tangibly do. Two things. One is ask every client, what do they care about? And do they have interest in learning more about ESG, sustainable, mission aligned, impact aligned systems level investing, right? Ask them, do they have interest? Because I think we can often assume, oh, this client isn't a client that is going to be in fact, we find some of the clients we least expect. We have an incredible client that built their wealth in the oil industry and are actively still engaged in oil and chemicals and materials. And we did not think this was a client that was going to care about ESG and sustainable investing. Yet we raised the question when we were first getting to know the client. And I think because we raised it, that's the reason they chose to work with us, because we weren't afraid to bring the topic up. And in fact, they care deeply about it, particularly the next generation of their family, because of how the wealth was created, and feeling even a greater, the greater importance of being part of positive change because of where the wealth was created. So I just think we can't assume that because of where wealth was created or how someone's currently invested or what their age is, or or what industry they work in, that they don't have an interest in this. So I think make a commitment. We made a firm to ask every single client we work with if they have interest in learning more about ESG and sustainable investing. And the answer is overwhelmingly, yes, I have interest in learning. It doesn't mean I'm going to move assets tomorrow, but I have interest in learning. So I think that's a commitment we can all make, is to bring the topic up with every client. And I'd say the second piece that's really tangible is creating an investment policy statement. I mean, we all know that that's sort of number one critical step in being good investors, is to lay out an investment policy statement and put it in writing. And it's amazing by just going through that exercise, and to Nakia's point, like really asking what do they care about and what are their goals. But when you actually put it on paper and they can reflect on it, it becomes an incredible guidepost that you can continue to revisit. So whether it's an our understanding statement or a investment policy statement, we found that incredibly helpful exercise.
Sorry, I think my husband just coughed. I'm going to leave you a minute, Rick. So get ready. I would just say that education of the issues is super important. Listening to clients and creating investment policy statement is absolutely right up there. But also making sure as practitioners that you have a really deep understanding of some of these systemic challenges. And we got Bill and Steve Lydenberg's book. I'll put a plug in for them. I'll also put a plug in for US SIF. I serve on the board of directors of it. It's a nonprofit. It's an industry trade group. If you want to learn about ESG investing, impact investing, however you want to call it, they have a lot of free materials. You don't have to be a member to tap in and learn more about it and dig in. I would also encourage any firm on this call to join us, USIF, come and be part of it, be part of the discussion. It's really like, it's a group that's really dedicated to advancing the quality and the like a better standardization and more robustness in the ESG industry as a whole. So it's, I think, a really important organization, which is why I volunteer for them. But Rick, maybe you want to take us out.
Sure, thanks. I will echo what Dune said, ask every client. It's remarkable to me how many advisors are missing an opportunity by not bringing this up. The data shows that maybe 20 or 30% of advisors are asking their clients about this. If you wait for your client to bring it up, maybe only 10 or 20% will ask, but that's because they don't know. They don't know it's possible. They probably aren't asking you about emerging market bond funds either, right? But you still deliver those types of solutions. So definitely be proactive, definitely bring it up with clients. The vast majority will engage and be interested. And then one tactical thing, if you're nervous about bringing this topic up, and I know some advisors are, they worry that this is too political, it's too, it's religious and politics, and you don't want to bring that up with somebody you don't know that well. If you bring it up, introduce it as a smart way to invest. I think it was Dune or Kim who said that at the beginning. It's just a smart way to invest. We found new sources of data, and there's a growing body of evidence that companies that manage their environmental and social risks really well tend to perform better. Are you interested in learning more about that? Of course, everyone's going to say yes. You're not going to get a violent no to that kind of a pitch. And then you can explore a little bit more about the other potential benefits of investing this way. And if the client leads you in that direction, you can lean in on it. If they say, you know what, I only care if there's performance there, that's fine too. You can engage at that level. So bring it up in kind of a safe way of, this is a smart way to invest, and then see where the client takes you. That would definitely be the best practices that we're seeing from some of the advisors that we work with.
Dune, Kim, Nakia, Rick, thank you so much. I think this was, incredibly insightful and diverse and helpful to our audience. I'm certainly encourage those who are on the call and those who might watch it in a replay to reach out to us if there's some follow-up, some ideas you'd like to hear more on, or some way we can develop this further. I'm going to give Bill the last word. Bill, did you come away with some work from this? And what are your thoughts for what's next?
Yeah, no, so I thought this great panel, great discussion, and I think everybody highlighted different dimensions of this opportunity and some of the tension points of actually like going in this direction. And I think you all offered really good, tangible kind of next steps. And so I would just offer two more. So one is so TIP recently embarked on something we're calling the Build the Market Initiative. Really, how do you take this kind of period of uncoordinated innovation that that everybody's been kind of trickling at? USIS's been nibbling at it. There's other groups, Money Management Institute, CFA Institute, everybody's been doing different things. So how do we start to move from that uncoordinated innovation to actual marketplace building? We have a big industry needs assessment that we're working on, where we're looking at all the different segments of the community and really understanding the temperature check on opportunities, challenges, breakthroughs needed. That will come out, but we're doing early results of all of that. That'll come out in the spring of next year. We're also developing a turnkey solution where it's really trying to say all those steps I highlighted, what's all the kind of process, guidance, support, templates, all that stuff that's needed to like really, get this implemented in investment policy statements, belief statements, all of that. And then the other thing that we're building, which I encourage everybody to check out, is something we're calling a community of practice. And so really trying to exactly to this point of really saying education and training wise, how do we start to bring all these different segments of the community along with the kind of support that they need? Beyond that, there are others that are doing really good work. So if you want to know more and probe deeper on kind of the investment structuring dimension, Delilah Rothenberg and the Pre-Distribution Initiative are doing really incredible work on that. If you want to know more about shareholder engagement and how this kind of systems lens really gets integrated there, Rick Alexander and the Shareholder Commons is another really fascinating group. And then if you're kind of really enamored with the whole SDG frame, Mirta Castropelli and Beyond Alpha are doing some really interesting work on that front. So anyways, just to say there's a growing ecosystem of players that are doing this. Exactly to Kim's point, a lot of the more heritage associations and institutions and research think tanks and all of that are all starting to pivot in this direction as well. So there's a lot of resources out there and a lot of them are free. So I encourage you to check them out.
Thank you, Bill. Thank you, Dune, Kim, Nakia, and Rick. And thank you for everyone who attended. If you found it valuable, let us know. Let other folks know about it. We will make it available. And we are eager to continue this series and look for other ways in which we can move this conversation forward. Thanks to everyone and have a great rest of your day.
Thanks.